you want to make a lot of money, you form a corporation. Corporation's a great wealth creation vehicle. So if you're a private company, how do you do it? Well, the world's full of people that have to buy private equity. So instead of raising $5 million to launch your whatever company, raise $50 million and put $5 million in the company and $45 million in Bitcoin. And the average company is growing 1%, 2%, 3% a year. And the 45 million Bitcoin component is a digital monopoly growing 30% a year, right? The VC will give you the money because the VC want to buy preferred equity, in a private organization. So if I had a private startup, I would just overfund it and I would capitalize the treasury in Bitcoin and raise more, right? You raise $500 million in capital, you buy Bitcoin, you have a $500 million business. This monopoly growing 30% a year. If you do nothing the rest of your life, you're going to be a mega billionaire. Actually, you probably only need to raise about $20 million to be a billionaire. If you raise $20 million, put it all in Bitcoin and wait, you'll be a billionaire in 10 years at the rate it's compounding. So not complicated, right? Let me say it a different way. You can raise money to launch a restaurant or a hotel chain or one of 18,000 software companies, and they're all very competitive businesses, or the next one of 5,000 banks or 5,000 insurance companies or whatever you want. The failure rate on a business is 95 to 99% over a decade. Eventually, if you're not Microsoft or Google or Amazon or Meta, if you're not a digital monopoly, you're running up against them. 27,000 retailers fail. Walmart powers forward, Amazon wins. That's the story of retail, right? Hotel. Every hotel company is a failure, right? Marriott doesn't own hotels. Four Seasons doesn't own hotels. Hilton doesn't own hotels. They all have management contracts. Why? Because the hotel business doesn't make money, right? Restaurant. McDonald's is a REIT. They don't run restaurants. Their business consists of getting other people to invest in the restaurant because they know it's not going to work. You're a software business, you're competing against Microsoft. They have monopoly. Microsoft's more powerful than the United States is. You could more easily leave the United States than you could exit the Microsoft network of your corporation. It's sad, but true. If you have to choose between American citizenship and giving up your passport or getting cut off by Microsoft, and once you look down at your Apple phone and figure out whether you're more afraid of being kicked out of Florida or having your iPhone iCloud account canceled by Tim Cook. Think about it, right? What happens if Apple just says, we canceled you? You'd rather be canceled by any city, any state, or any country than be canceled by Apple if you have an iPhone. So if you're running an operating business, it's very, very difficult. So what do you want? You want a monopoly. You want a digital monopoly. Okay, Bitcoin is a digital monopoly. It's a digital monopoly on money. It's the most powerful digital monopoly. So anytime you buy Bitcoin, you are merging your company with the digital monopoly growing 30% a year, unstoppable, that's global, right, with no attack surface. So if I'm a private company and I'm small, I want to raise venture capital, capitalize on Bitcoin, and then bolt it to the balance sheet. If I'm a big private company, I want to sweep my cash flows into Bitcoin because your big private company is growing 0 to 5% a year and Bitcoin's growing 30% a year. It's not complicated. You can either take all your cash. By the way, what do companies do with money? They give it away. They give it back to the shareholders, right? You can give your cash away via stock buyback. You can pay a dividend, or you can put it in a money market instrument that yields 2%, or you can invest it at 30% plus, tax deferred forever. Which of those makes the most sense? Corporate finance, and this applies to public and private companies. The conventional corporate finance theory for the last 50 years is, I want to run on minimal working capital. I want to buy back my stock, lever up, probably pay dividends, and if I have excess capital, I put it in treasury bills, short-dated ones, between 0 and 3 years out. I don't want to gamble the corporate money on equities. I don't want to buy long bonds, etc. I want to run working capital light. And if I do borrow money, I want to borrow the minimum amount. So that's corporate finance. And what does every big bank do? Every big successful bank, they beat earnings estimates, they raise their dividend, and they announce a bigger buyback. Everyone. Citi, JP Morgan, B of A, etc. What does every big tech company do? They beat earnings, they raise their buyback, they announce a dividend. Huh? Every well-run company in the United States is in the business of surrendering capital. Think about it. Here's my suggestion for your family. You have a lot of money, and you have it in stocks, and they go up and they down, and it's volatile. So why don't you just give all your money away to charity and have nothing, and your family net worth will not be volatile anymore. You see how stupid that is? It's literally the most moronic suggestion. Give all your money away, and your family's net worth will not be volatile anymore. That's what companies do. That's what public companies and especially public companies in the United States. That is the corporate playbook they teach you at Harvard or Stanford or Yale. And think about it. It's just literally the stupidest thing imaginable. NVIDIA became the greatest company in the world. They'll generate $300 billion in cash flow. How many companies in the history of the world have done that? One. How many companies are there today? 400 million. You're the most successful company out of 400 million companies. You generate $250 billion in cash flow in 3 years. And what is your finance strategy? Give it away. So what? So you just won the lottery, 1 out of 400 million, and you're going to give away the winnings, and then you're going to roll the dice again, hoping that you're again the 1 out of 400 million. Now you've got to ask the question, why is Xerox gone? Why is Kodak gone? Why is Intel in trouble? The company I worked for when I started my career was DuPont, right? It turns out in like 4 years, my own company created 4 times as much value as DuPont is worth. And when you look at it, DuPont gave away more capital in dividends and buybacks than they're worth today, right? And Intel gave away $100 billion of capital. And now the line is, well, we can't afford to build a chip fabrication or compete in the AI industry. Why? You gave away all the money, okay? Corporations are like type 2 diabetics. Sorry, type 1 diabetics. A type 1 diabetic is someone that cannot form fat cells, so you can eat yourself to death. And a corporation that surrenders its capital via dividends and buybacks as fast as it can becomes a Toys R Us, becomes one of the 19,000 bankrupt companies that are roadkill on the information superhighway. They cannot store economic energy. What is your life expectancy if you cannot store energy, right? It's weeks, months. The reason the companies last 10 years or 15 years on average, it's not because they're defective ideas. It's because they don't have any capital. They decapitalize as a process. So how do you make money? Well, if you want to make money, I'd say first you start a company. It's obvious. Second, you raise, remember I said buy Bitcoin with somebody else's money, raise capital, raise venture capital, equity capital, private equity. You have something that's, you have 20 million in cash flows. Well, go to a bank, get a $100 million loan, buy 100 million of Bitcoin, let it appreciate 30% tax deferred. You'll have $10 billion of capital by leveraging the 20 million of cash flows, right? Or you can just take the 20 million in cash flows and give it away as dividends, and you have nothing in 10 years. Or you can invest it in money markets, and the money is losing 7 to 10% of its value a year, and you're getting 2-3%, so you're like minus 5% at best. The cost of capital is 14%. That's the S&P index. So if you're not accreting capital faster than 14% a year, you're getting poorer. You're not getting richer in real wealth terms. And you can judge that. You know, an acre of land in Miami Beach was $10,000 in 1930. It's $10 million today. That's, someone's telling you, right, 2%'s enough. It's not enough, right? I mean, think about 10,000 to 1,000x more expensive in 90 years, right? That's 7% a year, by the way, 7-8% a year, so that works out. So I think if you want to make money, right, as a corporation, if you're private, you find a way to raise capital and you buy digital capital with it, and as long as you're paying less than, if you're paying 10% or less and investing it at 30%, you're capturing the 20% spread. It becomes a finance exercise of how much capital can you raise and under what terms. By the way, good capital, equity. You know, equity is forever money. Preferred equity that has a dividend is Macaulay duration of 10 to 20 years. That's 10 to 20 year money. Debt that comes due in 5 years is 5-year money. A margin loan is 1 week money, 2 days, 3-day money. You go on a crypto exchange and you lever up 30 to 1, that's a flash loan. That's 3-minute money. Like you can literally be you could have $1 billion of capital in the market and be forced liquidated in 3 minutes. So when you think about this, not all leverage is equal, right? Having the money for 20 years versus having the money for 20 minutes is different. A lot of crypto bros, they want to go and lever up 10 to 1, 20 to 1 and catch the dip and ride it up. And it's not the wrong idea. The problem is their capital is 10-minute capital. And it's very seductive because you can have $1 billion of capital if you want to get liquidated in 10 minutes. Having $1 billion of capital for the next 100 years is a little bit more difficult, right? It's more challenging. So I think you want a company, there's a hierarchy, right, of these things, right? I laid out the hierarchy of capital from flash loans to permanent equity. What's the hierarchy of companies? Family business, partnership, private, small private company, big private company, you know, small public company, mid-sized public company, big public company, right, in the U.S. capital market. And every single step up, right, you create a vehicle that can create more wealth. If you had a $500 million business holding slow real estate, I would say, well, bolt on $500 million of Bitcoin, wrap the thing together, take it all public, sell the equity, right? And now you've got a digital real estate business, right? You're creating value by creating growth and volatility, and then also liquidity in equity. And those are all things that are possible. Bitcoin is digital capital. I'm describing all the ways you can capitalize. You capitalize your private fund, your private company, your public company, et cetera, your endowment. You can capitalize with digital capital. It's going to outperform the S&P by a factor of 3, right? That's very simple. For 300 years, the Western world ran on gold-backed credit. All the sovereign debt from France, Germany, the UK, it was all gold-backed credit. The currency, the United States currency, $20 to an ounce. The US dollar was gold-backed credit. US bonds were gold-backed credit. So that's the status for 300 years in the Western world. Now we're moving to a world of digital gold-backed credit, digital credit. So what does that mean? If I know that Bitcoin's going up 30% a year, I can sell you a credit instrument that gives you 10% dividend yield. I can over-collateralize at 5 to 1. I can strip 95%. A lot of people aren't sure whether Bitcoin's going down 10% in the next year, but the likelihood it's going down 90% in the next year statistically is 1/100th of that. I can strip 99% of the risk off the instrument by over-collateralizing it. I can hand you 10% of the yield. I can keep the other 20%. So you issued credit which meets the need of a credit investor. And then you get the capital back. The credit is long duration. Like when we sell a credit instrument, we could sell $1 billion of a credit instrument. The creditors give us $1 billion. We give them back $100 million a year. We buy Bitcoin. It goes up 30%. We generate $300 million a year in operating income tax deferred. It compounds. We end up with $10 billion on the back end. You're looking 10 years out. We have $100 million of dividend obligation. We make $1 billion up front. We make $9 billion on the back end. We make $10 billion by selling. Think about this. You sell $1 billion of credit, you just made $10 billion. Think hard about that. What other business can you sell $1 million of a product and make $10 million?